First of all, I would like to go through with the assignment again because of few students they ask details since they were unable to join last session regarding the assignment and all because we did few changes to the assignment, so therefore we made few changes, not big major changes. We made only small changes because as per the request made by the students, so the treaty analysis, because individual assignment the weightage is 30%, because it is very useful to do this assignment because you can grab take 30% out of 100, then it is easy for you to score in the exam. The balance 70% is based on the paper. That's the main purpose of we gave this assignment, that if we give the entire 100% in the paper, it will difficult to score at that time. So it is easy for you to analyze, because here you need to analyze only for 2 DTAs. Here previously we allocated expected to 6 DTAs. Now you need to analyze only 2 DTAs. 2 DTAs should be selected preferably between Sri Lanka and uh, and other countries, Sri Lanka and whatever the country you prefer, right? It may be India or China. Better if you can compare India and China. Even you can take Singapore, Canada, Italy. These treaties are recommended. You can use and analyze the whatever the based on your preferability. So these are the articles you need to analyze based on the DTAs. I will quickly go through with one by one the PE. PE is permanent establishment, the business profit, and the passive income is mainly dividend, interest, royalty. There are 3 articles, right? Then you can go separately interest, dividend, interest, royalty. Then when it's come to Indian DTA, then the royalty and technical fees coming under one, because you have technical fees article only uh, in the case of only in India and Vietnam. So therefore if you are going to analyze the Indian DTA, you can see the technical service fee. So in that context, then you need to analyze the DTA. You can whatever the method you can use. Then you can column wise you can analyze the articles separately, and between India and China, let's say, you can draw a column by analyzing this article. So you can make the first column is the based on the IRA provision. What IRA says, let's say permanent establishment, you can take the things from the Inland Revenue Act and the TUT we discussed. What is IRA says, Inland Revenue Act says. So the next column you can say what is DTA between Sri Lanka and India says. Then the next column you can say what is the uh, DTA between China, India and China. So then you can analyze these 3 treaties together with this article. Then you need to mention the IRA provisions as well. So then the business profit and the dividend and the independent personal services. Today we are going to discuss dependent personal services, what is and the method of eliminating double taxation. So these 7 articles you need to analyze, not all the DTAs, only these 7 articles you need to analyze. Before moving to that article analyzation part, you just you need to just mention about discuss about the brief introduction. What is the DTA and highlighting source principle, resident principle, and the uh, 3D models. The 3D model in the sense OECD and UN model. We discuss in the class and together with the TUT. We have 2 models normally, generally we use in that the OECD and UN model. Then you just need to emphasize those 2 models. What is the main difference between those 2 models? If you can refer that, you all the things are there, right? Uh, and then uh, yeah, tell me. Then let me share the article as let me share the DTA, and then you can have understanding about the then the what is the article. Because before when you are doing these things, definitely you need to download the relevant DTAs. Uh, if you want in the group, even you can request whatever the DTAs you need. I shared the uh, website which is included several DTAs. If you want me to download and share with you, then let me ask you, just put a message and which DTAs you are going to analyze, and I can share the PDF version as well. So if you go to the DTA, because this is the DTA with India. This is India, Sri Lanka and India. Then you just go to the DTA, and what are the articles I have asked you to analyze is first one is permanent establishment, Article 5. And what you need to do is this Article 5, you just need to analyze together with let's say China. Let me open China DTA as well for you. Right here, if you can see, can anyone tell me whether you can see the screen, the GTS which I am sharing now? It's China, right? This is India. Can anyone see this? Okay. Then then if you can go to the permanent establishment, because I discussed this thing anyway, I will go through it again. The permanent establishment, it is Article 5 in the China, and also in the India also the same permanent establishment, Article 5. Then you need to analyze the whatever the content. First of all, you need to write down what IRS is, and the analysis part. Then you can compare in what the India DTA between Sri Lanka and India, what it says. Then if you can see this one and compare, then they have only A to F in the case of permanent establishment. Normally, they permanent establishment mean they say that fixed place offered through a business which is business of enterprise wholly or partly carried on in term of permanent establishment, which include they say A to F, right? A to F item is basically fixed base. So then if you go to India, they have A to I, not F. They have additionally they have these three. Then you need to elaborate that. Then highlight. They are going to in detail in order to grab the permanent establishment. Then why permanent establishment is important? Then if there is a PE created in Sri Lanka, then we are going to tax in Sri Lanka if it is PE is there, right? If it is PE is there, then if you can go to next one, 3, building and construction PE, construction as installation as assembly project. Then if you can read that one, it says 180 days in India data. Then when it's go to China, building, assembly, construction, installation project, it is also 180 days. Just compare those two with the IRA. IRA also we discuss in the tune, right? It says at least 180 days. So building. The China treaty says within any 12-month period. That is, it's emphasize any 12-month period. The China India one just say 180 days. Then when it's come to service PE, China says it should be service should be carried in Sri Lanka 180 days in 12-month period. In the case of India, it says 90 days. 90 days. That's it. The notwithstanding proceeding those. These things are not importantly analyzed. The whatever the basic concepts which are relevant to DTAs you need to have, whatever discuss in the tune, you just analyze those. Then the main differences. So when it's come to, as one student is asking, the business profit and then dividend, if you can dividend article, you just compare these two, dividend with China one. Those are passive income. Dividend, this one. In the case of dividend, it is 10%. It is 10% in China. In India, 7.5%. That's those things need to be analyzed. Then the first 9 months is okay. Then the last 3 months, what we discussed was because reason changes, dividend paid by resident company to non-resident person is now exempt. No need to deduct. In this case, then there is a benefit they have granted for non-resident person in order to why they have removed the dividend tax, withholding tax on dividend. Why the recent government they have removed withholding tax on dividend from non-resident shareholders. Why? What is the reason? The reason government they introduced. Can anyone tell me? Sorry? Why they have recently introduced that one in order to bring foreign currency into Sri Lanka. Then if there is no any taxes on their return, then that means dividend. They are willing to invest in Sri Lanka. Then they can take it entire 100. So that is why they have introduced those policies in order to balance the exchange rates fluctuation. So those policies, every policies, tax policies, they have some reason to implement those things. Then when it comes to interest, also if you can see the interest part, then it says the rate applicable, it's 10% in the case of India, right? It's 10%. When it's come to China, it's also same, 10%. 10%. But IRA says 5% for 9-month period. 5%. 5%. Then what is more burdensome? If the DTA says higher rate, but IRA says lower rate, then are we going to apply higher rate? No. We can apply the lower rate as per the IRA. Then 5% we can deduct. But together with recent changes, the foreign person who are providing loan to the Sri Lankan company, then that interest also exempt. Then you can mention that one as well, because we discussed last week. That part also you can take from the last week session, the recording, because it is duplication. It is not fair if I discuss again and again those things. The students. So then when it's come to royalty and fees for technical service, the Article 12 is in the case of India. Article 12, royalty and technical service fees, they have mentioned together. You can't find out separate article for fees for technical service. Then when it's come to royalty, and it's embedded the fees for technical service as well. When it's come to China TTA, it only says royalty. They don't have separate article for technical service. Technical service not covered under China article. Then it is only included in the India. Only India and Vietnam. Then if you are not going to compare the Vietnam, then if you are going to compare with China, you can mention that difference as well. Then the China DTA, they don't have technical service fee article, but India they have included, which is included into the royalty. Then the royalties and fees for technical fees, they have explained that one. The rate is 10%. Then IRA Act says 14% for royalty. The technical service fee also 14%. But the DTA says lower rate, we can apply that one. When it's compared with China, they don't have a separate article, but for technical service fees, then the royalties we can go with 10%. In the case of technical service, which Chinese technician, if they come into Sri Lanka and doing any technical service, then what we have to do is we need to decide whether there is a PE or not. If there is a PE, then such profit we need to tax it as under business profit article. If the technical service fees does not create a PE, no fixed space, no, they are not service fee, they are not exceeding 180 days, then the service PE, if you can go to the service fee article, then Chinese, let's assume as an example, Chinese technical engineer came into Sri Lanka, engineering people, they are coming to Sri Lanka and doing the technical service in Sri Lanka. Then the furnishing services, then they should stay more than 180 days. Then we can justify that they are not exceeding 180 days. Therefore, they are not liable to tax in Sri Lanka. Then no tax clearance. We just draw the diagram. Let me elaborate that diagram today as well. Depend on the time, right? Then likewise, you need to analyze those articles, whatever the articles given. So anyway, we are going to discuss independent and dependent personal service as well. Then you can have that understanding as well. So if I'm moving to the individual assignment, then the minimum word limit is you need to prepare your report based on your presentation guideline, right? Times New Roman and the font size, those things are strictly monitored. You need to comply. You can't use different fonts for different. When you are even copy pasting, then those things are not allowed. You can create on your word better. So and the minimum word limit which is included newly, 2000 word, you can go beyond that. Then that is not expecting you to go beyond 6000 7000 words, because it is also lead to hassle to mark and analyze by balance the pay assignment. Then the minimum is 2000. You can go maximum 4000, let's say 4000 5000 maximum. Don't go beyond that. Then it can be a kind of, not the report, the kind of book. So therefore minimum limit is here in order to have a good report. The maximum you can write it down as you wish. Better if you can below the 5000 at least. Then you can come up with the standard assignment. So are there any questions on that before moving to the tube? Hope you don't have any questions. So okay, then today we will do one question. If we have the passive income, those things are there, what we have discussed. So here we are going to discuss today independent personal service. Independent personal service, in the sense what? Independent. Independent is they are not attached to any company. They are coming under their individual capacity. He might be engineer on his own capacity, lawyer, kind of, let's say athletic, educational, or they are coming under teaching activities. They are coming and doing literary and scientific. Then the professional services, basically professional services identified include services performed in the exercise of independence. So basically these activities as well as exercise on the independent activities, basically lawyers, physicians, lawyers, engineers, athletic, artistic, dentist, accountants, those people. Those people, if they are coming to Sri Lanka and doing and providing their service, and they can get money. I will read the basic simplified version of DTA. Better if you can keep this way, because you can grab the word in as it is. So under the tax treaties, a resident of a contracting state, let's say Indian person is liable to tax his income from independent personal or professional services in a country of residence. Then it says that whatever the income he is earning, liable to tax in India. Liable to tax in India. Right? Then, however, it says he may be taxed in Sri Lanka as well. Indian person who is coming into Sri Lanka, then that person may be taxed in Sri Lanka if he has a fixed base. Then that's why I refer to the PE concept, PE article, fixed base, service. Fixed base, if here I have mentioned as example for India for you to understand clear, grab the wordings and all, in order to grab the wordings and all, fixed base stated in that state, Sri Lanka, fixed base in Sri Lanka, or if he is present, stay physically present in Sri Lanka more than 180 days or more, basically 180 days or more in 12-month period. If that person stay in Sri Lanka more than 180 days, or maybe fixed base, maybe office or factory or those things we discussed. And under service, PE also there, it is coming under 180-day rule. If it is fixed base, is the one condition. The second condition is physical present. Then he become taxable in Sri Lanka. Either one or both conditions are satisfied. He may be taxed in Sri Lanka. Either one or both conditions are satisfied. Maybe one is fixed base, other one is 180 days or more. Then he may be taxed in Sri Lanka. Then it is clear. Independent personal service is clear. We have only just two rule. Then you need to check those two. If it is so, they are going to tax in Sri Lanka as well. Then the exemption is given in the case of artists and athletics. Then the sport persons. If they are coming into Sri Lanka, their income from personal service may be taxed by the state which activities are carried out. Normally, if say sport person is coming and doing some activities and he sometime may earn profit from Sri Lanka, then disregarding the above rule, we need to consider that amount as a taxable income. So maybe tax. That's it, right? There is a separate article for this, but if you can go to these three, is the exactly what article says. So then when it's come to dependent personal service, dependent is they have employer-employee relationship. Then that means employment or dependent personal service. Employment or dependent personal service. And employment or dependent personal service, when it's come to dependent or employment or dependent personal service, there are three conditions you need to check. Right, I will go through one by one. From the beginning, the income from employment is also taxable primary in the country of residence. That may be in India. Let's say Indian employee, he is definitely is taxed in India, right? No worries. Then, however, resident of a contracting state, that means Indian person, carrying on employment in the other state, then he is coming to Sri Lanka for employment, maybe 2 year, 1 year contract. Then maybe tax in other state. Then in that case, he may be taxed in Sri Lanka. He may be taxed in Sri Lanka, right? He may be taxed in Sri Lanka. In that case, then the country of residence, India, can tax only if it only can tax it only if Indian country of India, then the country of residence, basically India, can tax only these, all the conditions are satisfied, all, not even one. Then otherwise they are going to tax in Sri Lanka. Then then what are the conditions? If those all three conditions are satisfied, he may be taxed in India. If not, he may be taxed in Sri Lanka. Then let's say one by one. Physical person in Sri Lanka less than 180 days. If he stay less than 180 days, then we can't tax it. But not only this, this is one condition. This is plus. And then second one also should be there. If any person, Indian person who came into Sri Lanka, if he exceed 180 days, definitely he will be taxed in Sri Lanka without any uh, dispute, right? So first condition is he should be less than 180 days. This is just I put India as example. You need to go to the treaty exactly how it is worded, right? Uh, then uh, then the remuneration. Then the remuneration is paid by employer not resident in Sri Lanka. Employer not resident in the contracting of Sri Lanka. Then that's mean Indian companies paying salary. Employer not resident. Employer not resident in Sri Lanka. Employer. Then the salary also paid by Indian company. Then if it is less than 180 days, then let's say this condition also satisfied. This condition also satisfied. Then the remuneration is borne by a PE or fixed base, not borne by a PE or fixed base in Sri Lanka. Then the PE, let's say if an Indian company also coming into Sri Lanka, they have created a PE or fixed base, they had build an office or the site or maybe office premises, they started the kind of branch, then there may be a fixed base. So if it is not so, then if it is this condition also satisfied, then if all three conditions are satisfied, then that person may be taxed in India. Keep in mind, all three conditions need to be satisfied. Here the N is the important word here. And if you can read the article, DTA, here you can see N. Let me share the DTA with India as well. When it's come to India DTA, it's here. Put again independent personal service we discussed. Here you can see independent personal service. What is the dates? 180 days and the fixed base. Fixed base. We discussed those two rules, right? In India, you just compare. You need to just compare with China. Here, in the case of China, independent personal service, Article 14. They also had fixed base and 180 days. Same, right? Then here, dependent personal services, then in India, it says 180 days rule, and the remuneration is remuneration not a resident of Sri Lanka. Then the remuneration not borne by PE or fixed base. Right? Here the important wording is and, right? And is important, right? When it comes to China, also and is important. Then 180 days, the remuneration not a resident, the remuneration not borne by a PE or fixed base. So those things are there. If all the conditions are satisfied, then that person may be taxed in India or China. Then if it is one single condition breach, then definitely that person taxed in Sri Lanka. Is it clear? Right. Then the employment, in the case of employment abroad, a ship aircraft is taxable where such ship or aircraft is deemed resident. Deemed resident. That is where the place of effective management is situated. That is where the place of effective management is situated. Basically, then only you can decide whether that person is going to tax or not. Then if it is ship or aircraft is taxable, where the such ship is deemed to be a resident. The normal principle is if we are going to Inland Revenue Act, then where the ship or aircraft is registered, ship is registered in Sri Lanka. Then the DTA says that effective management situation. So those are the things we want to discuss here. Independent personal service as well as dependent personal service we discuss those two. Then the elimination of double taxation principle, the tax credit method. I just want to emphasize this one because exemption method we have only few DTAs. Mainly they are going with tax credit method. So the mostly used method. So then the credit is how the credit is taken. We discussed last session. And this is one of the publicly available question I have taken with you to discuss, and this question may be useful for you, and the answers also will discuss today itself. I will read this question first and move to the answers. Before moving to the question, I will read for you what are the requirement. Requirement is support your answers citing the statutory provisions of Inland Revenue Act number 24 of 2017 and article of double tax treaty between Sri Lanka and India. Here, the first one is analyze if Hera is required to pay income tax in Sri Lanka. The analyzing part, whether Hera is required to pay income tax in Sri Lanka. Then the second one, they are asking compute the income tax payable by Hera, including remittant tax for the year of assessment. Let's make it as 1920, right? 1819 even, right? We can make it as 1920. And then they explain to the finance director withholding provision relating to royalty and the applicable income tax rate on royalty income. Then the royalty we know it very clearly now. they explain if Mahesh has to pay income tax in Sri Lanka on following income: the employment income, profit on sale of machine. Then those things we need to discuss. We will go to the case first, right? We will go one by one. We'll highlight in the scenario. Hera is a company incorporated in India. See they have clearly given incorporated in India, right? Incorporated in India is very important point for tax purpose, right? Incorporated in India. Then which manufactures and sell diamond cutting equipment to Sri Lankan company through an agent. See, there is a agent relationship also. Then we can assume that we discussed last week how the agent, whether it is dependent agent or the independent agent, how we are going to determine those things. Then it is very clear for us. Then it's given, right? Then we will go into the scenario and we'll see how they have worded this. Then the Salia Equipment Private Limited, which converse for orders and conclude the contract on behalf of Hera. Then they are taking orders, enter into the orders, taking orders and conclude the contract, right? Then on behalf of Hera, then kind of not independent agent, kind of dependent agent, right? The first one condition is they says that they are entering in, taking the orders, and also they are conclude the contract. Then the Hera sold several machines to Sri Lanka, companies in Sri Lanka, and these machines require constant repair and maintenance. The machines are required subject to maintenance. Then currently, Hera send its engineers and technicians to provide such repair and maintenance services on an ad hoc basis as and when the need arises. Then they are send their engineers and technicians to provide the repair and maintenance service in ad hoc basis. Okay, right. Then the finance director, next para, the finance director of Hera has suggested that it will be more cost effective, efficient to attend to the repair and maintenance work through the agent in Sri Lanka. See that now situation also get inverse the COVID also. Then that is one also maybe condition, they are not willing to send the employee, same as that the previously. And also it is not the case for this scenario. This is basically they need to transport cost avoid, they can avoid that one, the time they can, if that engineers stay in India, then they can maybe use kind of opportunity cost maybe there. So that when compared that, they are not willing to send the employees into Sri Lanka. Then they are willing to do the repair and maintenance work also through the agent in Sri Lanka. Through the agent. Then agent is getting more work than the previous, right? Agent is getting more work. Then an employee to employ the engineers and technician locally. Then they are going to ask to Salia Enterprises to employ engineers and technician locally. So Where the necessary technical skills are not available, employees of Hera would send from India. Then if it is the big issue, kind of machine repair, then they will send the Indian technician in order to sort it out. So accordingly, during the year of investment 1819, then the Salia Enterprises commence providing repair and maintenance service Sri Lanka exclusively to the exclusively to clients of Hera. Then see that this wording is exclusively the clients of Hera. Then they are not doing any other service. This is also one of indication as a dependent agent, right? Dependent agent. Providing repair and maintenance. Commence. Salia is commence to provide repair and maintenance. The answers are also in the scenario given, right? The SCL is governed by manual procedures laid down by Hera and not allowed to carry out any business on its own. Then it is also one of the main facts to determine that they are dependent. The Salia is totally dependent on the Hera then. The governed by the manual and procedures. Governed by the manual and procedures laid down by Hera. And see the wording, not allowed to carry out any other business its own. These are the conditions what we discussed last week, how to determine dependent agent, right? Then they will create a PE in Sri Lanka. So under agency PE. So what we discussed. So we'll move to the next para. The next line they are saying that Mahesh, who is engineer employed by Hera, was sent to Sri Lanka to train the employees of SCL. They are coming to train. The Mahesh is coming to train the employee of SCL. That is also an indication that why they are not sending the employee train SCL's employee. Also, there is a major dependency, right? And also to provide technical input for certain project and technical inputs. Then because he is one of expertise, then the technical input certain project that local engineers were not capable performing right? Then he had been present. So then he had been present in Sri Lanka 195 days in aggregate. He had been present in Sri Lanka 180 days, more than 180 days. It says 195 days within the year of assessment 1890. Then it's clear 1819 they have exceeded the 195. Then he had received USD 8,000 as employment income from Hera during the year of assessment 1819, of which 3,000 is in relating to the services which he has provided in Sri Lanka. Then he had received USD 8,000 employment income from Hera, in which 3,000 is relating to service provided, right, in Sri Lanka. That is clear. Then he had received 8,000 as employment income from Hera during the reimbursement 1819, of which 3,000 is related to services he had provided in Sri Lanka. Then entirely 8,000, 5,000 is maybe in India, then the 3,000 Sri Lanka. Let's read the case. Further, during the year of 1819, he brought all diamond cutting machine from Sri Lankan company and repaired, modified it and resold it to another company in Sri Lanka for a profit of 5,000 USD. Then he made a profit of 5,000. The profit of 5,000, that 5,000 is mainly he did entirely on his own one job separately without considering that employment income, right? So what in independent status, he purchased a machine, all machine, and modified that one and resold to the Sri Lankan company and made a profit 5,000 USD. Then income received. Income received and expenses incurred by Hera during the year of 1920 from its operation in Sri Lanka as follows. Then the income and expenses. They have given income and expenses during the year of 1890. Sale of machinery and equipment, it is major part, the Hera's major part. Repair and maintenance is small part. Repair and the royalty, they have 23 million. Sale of shares 450 USD, and the dividend received from a resident company, they have investment as well 900. Then expenditure, cost of machinery and equipment, commission paid to Salia agent, and the administrative and establishment, including salary of 3,000 to Mahesh. That is for Sri Lankan part, right? 3,000 to Mahesh. And the traveling and other cost. Traveling and other cost. Then altogether 50,000. Then the exchange rate they have given as 175. Then the finance director of Hera has stated that royalty income received by Hera from Sri Lanka should be taxed at the maximum rate of 10% under the Article 12 of the DTA between Sri Lanka and India. However, certain companies in India and Sri Lanka have deducted tax at 14% when making the payment to Hera. Right? This is the finance director says that this one. We will come back to this one when we are analyzing the question, because the finance director saying that then the tax at the maximum rate is 10% as per DTA. We know that DTA said 10%. It is no worries. But it is Hera is having a PE, no? I will explain it the answer. Because Hera is having a PE, then we can't directly take in as a royalty under withholding, because they are having PE. So we'll go to the answer. Whether we need to justify what this finance director says is correct or wrong. However, certain companies in Sri Lanka have deducted tax at the rate of 14% when making the payment to Hera. That's finance director saying that. Then refer to Article 5, 7, 12 and 15 of the DTA between Sri Lanka and India. Required these things. Analyze, again I am reading, analyze if Hera is required to pay income tax in Sri Lanka. Right? Can anyone tell me here whether Hera is required to pay income tax in Sri Lanka? Yes,
Yes, Hera has to pay income taxes in Sri Lanka.
has to pay. Yeah. Right. Any other answers? All I agree. I am assuming then all I agreed. Right? We'll go to the how you need to analyze the question. I'm just willing to change the year of assessment for you because it is easy for you to if it is change the year of assessment. Uh, uh, let's let me share the tweet again. Sorry. Right. In the year of assessment for your exam purpose, better if we can analyze the 1920 as you're sitting the 1920 with the changes. With the changes. I'm changing the all the year of assessment here as a 1920. Then the keep in mind if you are doing chartered exam, the you are supposed to write the answers without changes, right? Then the your exam, university exam, this is basically with the changes. We are expecting your answers with the changes. If you are doing any other exam, let's say chartered, then this time they are expecting without changes, right? Because the proposed changes are not yet enacted, not legally enacted, then those changes yet to be passed in the parliament. Then soon after parliament, the Sri Lanka will take the consideration of testing. But the under contemporary issues, they might test those things. The very lower mark, let's say 5% or 2% maybe. So, additional point I gave, right? We'll move to the answer how you need to write it down. It is very easy. That you know someone who can comment whether this uh, your exam is also in the university. This exam is also open book or the closed book. Anyone who got any names from the previous batch? Is it open book or closed book? You are having this. The text paper. Do you have any exam in open book? The university this or Tivani?
But anyway, I when I went through this course outline thing, I saw that it says as this is a closed book exam. It
Closed book, right?
specifically says, yeah.
Mm-hmm. Right. Okay then. Okay. Then if it is closed book exam, better if you can remember the sections. That doesn't matter. You will not lose any mark if you are unable to quote the sections. But the basic principles, if you can write it down, that's sufficient if it is closed book exam. Right? Section 69(4) is the main section you need to mention when you are analyzing the residency of a company, right? That is the main point because when we read the question, first of all, we understand that then they incorporated in India, right? Then we'll read this answer. As per the section 69(4) of the Inland Revenue Act, provide the criteria be satisfied by the company to be considered as a resident for tax purpose. then it says 69 as per the 69. 69.4, right? Then you can say that as Hera is a company incorporated outside Sri Lanka, incorporated in India. Incorporated Hera, you know that Hera incorporated in India and does not satisfy the criteria set out in section 69, set out in the IRA. You just say set out in the IRA and will be considered as a non-resident for income tax purpose because it is incorporated outside Sri Lanka. Then we discuss 69.4 when we are discussing the tune. Right? Here also non-resident part we discuss. Then here you just keep in mind whatever the highlighting things I am. The incorporated outside Sri Lanka, then in that case, as per that is he is non-resident. Then how the non-residents going to be taxed in Sri Lanka? Non-resident common tax venue. So it is clearly says in the section 4. Section 4, in the case of non-resident liable to pay tax in Sri Lanka, where to the extent that income arising or derived from a source in Sri Lanka. Then whatever the income they are arising or derived from a source in Sri Lanka, then the source principle. Whatever the income they are earning in Sri Lanka, not the world income. Then the residents are subject to tax in the world income, but non-residents only the income arises or derived from a source in Sri Lanka, right? Then based on the information provided, Hera has received both business income as well as investment income. We know that business income they are having. The Hera has business income as well as investment income. What are the business income? Based on this, business income is basically sale of machinery, repair, and royalty is business. And the investment part, gain on sale of shares and a dividend. So because royalties we are taking as a business income because they are mainly business and their license fees and royalty they are taking under machineries, right? Then the same answer, Sri Lanka has entered into DTA with India, right? Then we are going to DTA. As per the IRA, you need to elaborate these 2 points. Section 69.4 and section 4. You just you need to outline how the treatment as per that. Then you need to go to treaty. Then the how treaty says. As per the treaty, you need to mention that there is a treaty between Sri Lanka and India. Just mention that treaty. Then the Article 7 DTA provide that. Article 7 of the DTA provide that. Then the business profits, Article 7. The profit of an enterprise on a contracting estate, one contracting estate will only be taxable in other contracting estate. Then the other contracting estate means Sri Lanka, where such enterprises carries on the business in that other state. That means Sri Lanka. Through a PE, right? Through a PE. Then you need to link the PE concept. In Sri Lanka, if enterprises create a PE in Sri Lanka, such profit, the profit of enterprises attributable, these wording are very important, attributable to PE will be taxed in Sri Lanka. Attributable to PE will be taxed in Sri Lanka, right? Then if there is, you need to just look at whether they have a PE or not. Then how we are going to determine the PE? Then Article 7 says, if you have a PE, that property is liable to attributable to that PE. The profit attributable to that PE is liable. Then if you have in India, the entire property is 1,000. If the property is, let's say 400 property is attributable to Sri Lankan PE, then that income is liable in Sri Lanka. It says like that. Then how to determine PE is, then you need to explain as per the Article 5. Article 5 says, DTA provide the definition of PE. Based on the Article 5, subsection 5.5 of DTA, Hera is deemed to have a PE in Sri Lanka. See, deemed to have PE in Sri Lanka as Salya Enterprises, acting on behalf of Hera as dependent agent. Why the PE is coming as a dependent agent? We explained that one when we are discussing the agency PE, right? Then the Hera is liable. Why? Salya is here as a dependent agent. Then the Hera is liable for tax in Sri Lanka. Not the Salya anyway tax in Sri Lanka. Salya is doing business in Sri Lanka. Salya is anyway going to tax whatever the commission income he is getting. But Hera also liable to tax in Sri Lanka by under the agency principle, agency PE, right? If you have get not clear, you can raise questions, right? So then the services provided by Salya Enterprises on behalf of Hera and controlled by Hera, right? Then the services they are providing on behalf of Hera and controlled by Hera. On behalf of by Hera and controlled by Hera. Entering into the contact, taking the orders, those things, right? You can just elaborate this answer if you wish, right? Then, as such, Hera is deemed to have a PE in Sri Lanka. Deemed to have PE in Sri Lanka. And will be liable to pay pay income tax on income attributable to, then you need to just highlight the whatever the income attributable to P in Sri Lanka as a non-resident person, attributable to P, as you very correctly said. Then it is clear, right? You just need to emphasize. First one is Inland Revenue Act provisions, and the second one also the same. First one is Inland Revenue Act provision, section 69 and section 4. Then you need to analyze Article 7, how to determine, and then Article 5, right? Then we'll go to the next section. Hope this you got clarified clearly. If you still have confusion, you can raise questions. Then second one, compute the income tax payable by Hera, including remittant tax for the year of assessment 1920 on income and gain in Sri Lanka. Right? You need to calculate the income tax payable of a non-resident as a Hera company, non-resident company. Here, this is how you need to calculate. This is how you need to calculate the income, right? Income. So basically, profit, you know that profit is 50,000. Then the 50,000 exchange rate is 175. Both they have given. If I go back to the question, the exchange rate is 175. And the profit, if you go to profit is here, this one. Profit is 50,000, right? Then you just 50,000 multiplied by 175. This is the answer. Then you have gain on sale of shares, coded shares, not the normal shares, coded shares. It is also exchange. And for 50 into 175, 78. Then we need to remove those income which are exempt. Right? Then the dividend also 900, the 175, then this amount we are removing. Then the assessable income is 8.5 million. Then the taxable income also same. They don't have given any other information, the qualifying payment or uh, anything, right? Qualifying payment. So then the taxable income is 8.5 again. Then you need to apply 8.5 here and the tax rate. Tax rate is 28%. So then you will arrive tax liability, income tax payable 2.3 million. Then how you are going to calculate remittant tax? Remittant tax, how you are going to calculate? How you are going to calculate remittant tax is also the one important point. Then how you are going to calculate is, are you going to take this amount? Are you going to take this amount here? Or else this amount here? No. Can anyone tell me how this amount taken? This 8.59 to 500? How this amount taken? How this amount taken? Right. I will tell you how this amount we have taken is basically I will go to the again remittant tax slide. Remitted profit. Remitted profit. If you can go to slide number 21. So remitted profit under sections. If you can refer the section 62. Section 62. Under that we discuss remittance tax, all the detail, right? Then remittance tax, it says excluding dividend paid by a resident company to a non-resident. Excluding dividend paid by a resident company to a non-resident, right? Excluding that part. Excluding dividend paid by a resident company to a non-resident person. Then other things also you need to consider all the things. The remitted profit means amount remitted or retained abroad. That means ලංකාවෙන් පිටට යවනවා හරි නැත්නම් ලංකාවට එන්න තියෙන මේ PE එකට අදාළව එන්න තියෙන ප්‍රොෆිට් එකක් ලංකාවට ඇට්‍රිබියුටබල් ප්‍රොෆිට් එකක් නම් ඒක රිටේනබල් ඒක රිටනට තියාගෙන ඉන්න. එහෙම හරි. Amount received outside Sri Lanka. Amount received from outside Sri Lanka. Then they have provided services outside Sri Lanka. Then they have receive the income from outside Sri Lanka. The non-resident person are subject to income tax and any amount received in outside Sri Lanka or on behalf of the non-resident person from conducting business in Sri Lanka. Then whatever the business they are conducting in Sri Lanka also subject to tax. Then tax is subject to income tax in Sri Lanka. So excluding, very important part, excluding dividend paid by a resident company to an unresident person. Then we'll go to the question again. I just add this part in the, if you can refer the initial question in Sri Lanka. So that past paper question, this part is not there. I just added that one in order to emphasize this theory part. Quite good question. So included this dividend part as well. So how you can arrive this 895 is basically you need to take can anyone work it out and see 8.8.7 8.7 then 7550 7550 let's say 750 then you need to deduct gross income, whatever the remitting profit going to be remit, you need to consider. But this amount you need to consider, but this amount you need to exclude. Here 175. 175 you need to deduct. 175 point, let's say here comma 175.5 you need to remove, then you will get the answer 8.592.5. Is it clear? Yes, exactly. Right? Then this dividend income you need to exclude because you need to exclude as per the section. That part you need to exclude and then take it that part and you deduct whatever the income tax paid in Sri Lanka. Then you deduct whatever the income tax. Yes, good question. The new rate, then better to you have to divide it into two different periods, 1/4 and 3/4. I will explain that one in the whiteboard for you. So the 9-month and 3-month you need to calculate because this is how if it is without rate proposed changes. With proposed changes, you need to apply like this. I will share using whiteboard for you. Right. Here, you now aware that how to calculate, let's say how to calculate the taxable income, right? Taxable income is now you know. Can this whiteboard is visible?
Yeah, we can see it.
Okay. Then taxable income is now we know that 8 8.5 million 8.5 8513 750, right? Then what you need to do is you need to divide these two into two period, right? The first period and second period separately. Then the first period and second period. Then let's say I will 9 months and the 3 month. Let's say 9 month and 3 month, right? Right. Then I will draw a line for you to have clear separation. The taxable income you have arrived at. Then what you can do is you need to take this whatever the proportionately applicable for 9 month and 3 months separately, right? Then what you need to do is this 8.5 million 8.5 million divided by 12 multiplied by 9, unless you can take it 4 divided by 3, right? 4 divided by 3, right? Can anyone help me on what is the exact amount you need? 8.513750 divided by 4 multiplied by 3. Is it 6 million? Yeah, I got. This is the answer, yes. This is the answer, right? Right. Then the balance period, 1/4. 8.1, 8.1 divided by 8.5 million divided by 1/4. 8.5 million divided by 1/4. This amount. Right. Then what you need to do? What you need to do?
We have to apply 28% for the first 9 months and then 24% for the next 3 months.
Exactly, exactly. you need to apply income tax payable as income tax payable first 9 month period. First 9 month period, the rate is 28. The next period, 24%. Then tell me the answer. What is in million? We will write it down. No, the others. The in million. What is the answer? 28%. Let's say thousands. 1,788. Am I correct?
Yes, sir.
Then here is 2,128,437 into 5 into 24, 511, right? In thousand. Here I am just mentioning in thousand because in order to save the space, right? Then what you need to do? I will use another different color. Let's say, then what you need to do is you need to calculate remittant tax. The remittant tax, how you are going to calculate? What is the applicable rate for both period?
14%.
Yes, exactly. It is 14%. 14%. Then how you are going to calculate is 8.5 million divided minus 8.5 million. I will take this part entirely out of this box, right? Sorry, 8.8750. Then we are going to remove what is dividend part 157.500. Is this dividend going to exempt from the beginning or as a proposal? This dividend paid to non-resident person, dividend paid to non-resident person, is this a proposal or else we know that previously dividend under section 88 dividend was final resident person to resident company to a resident person, right? Then when it's come to non-resident, what happened previously?
Previously, we had, I mean, this is a new proposal.
This is a new proposal. Yeah. Then let me share the new proposal as well with you. Can you see the screen, the proposal?
Yes, sir.
Okay. Then here, if you can see the dividend removal of withholding tax. Here the new proposal. Here resident person, and then removal of withholding tax in the case of non-resident. Then with effective from 1st January 2020. 1st January 2020. Then the tax shall be deduct. The rate is specified subject to this one. Dividend they made exempt. Dividend they made exempt. Previously what you are required to deduct withholding tax 14% or the DTA rate. Right? Then the non-resident person, now it is exempt. If you can go to the exemption also, they have mentioned that one. Here. Dividend paid by a resident company to a member of who is a non-resident person. Here they have mentioned there is exempt. Then what you need to do is you need to see whether this dividend is basically belong to which period. Belong to which period. Then if it is 3-month period, it is exempt. If it is 9-month period, then that is even liable for normal tax perspective. Then in this scenario, because this dividend is newly added one, I would like to highlight in order to emphasize recent changes. This is the 3-month period dividend, right? I will modify the question accordingly. Then anyway, the 3-month period dividend is exempt, right? Then we remove, when we are calculating the plus minus, we remove the exemption. Then because dividend is falling under last 3 months. Then anyway, when you are computing the remittant tax also, what we need to do is we need to remove the dividend separately. So what we need to do is then we need to analyze. Let me share the whiteboard. And right. What you need to do is the remittant tax. When you are calculating the remittant tax, dividend tax part is belong to second period. Second period is basically 3-month period. 3-month period, dividend exemption. Then only the first month period you need to apply the 14%. Then the balance period is again 14%. Then the rate is no big difference. If it is rate is different, then we can determine that how we are going to decide the how you need to calculate the tax, remittent tax. But here is easy for you because the rate is same, 14%. Then no need, there is no any hard and fast rule to in order to become a tax effectiveness, because in order to minimize the tax, because you need not to analyze the dividend separately, because we can just exclude the dividend part and apply the 14%, right? Then the 14%, even this part you can see, if it is let's say I am just for your understanding purpose, I will do this change for your calculation purpose in 1000. Here again, let's say 3 months and 9 months. Let's say right. Here I will mention here. Sorry, I got a call. So 9 months, and here 3 months. Let's say for your elaboration purpose, I will just emphasize this part, two part. Uh, Here again, what you need to do is we need to take 7.5 million. Seven, sorry, 8.7 million. 8.7 million. I will take two parts separately. Eight. Can anyone help me on that? 1,750 divided by 4 into 3 is 1, right? One period. And then other period also the same basis. Here 1. What is the answer?
For the first 9 months, the answer is 6,562,500.
6 million.
That means 6,562. In thousands, 6,562.5.
Here
It's 2,167.
1,100 just only. Eighty-seven, 88.
Yeah, 87.
87, right. Right, then what you need to do is, this is the very clear presentation purpose. I just mentioned this one. Then you should deduct dividend, because dividend we came into an agreement, dividend is belong to second period, right? Then here you need to deduct dividend. If it is remittent tax also change this government, then this is quite useful calculation. Then the dividend is 150, 157, right? 157, let's say, rounding up purpose also, 157. Then what you need to do is, you can just take these two as it is into this line. Then you need to apply 6,563 into 14% is how much? And here 6,563, and here I'm just mentioning 2 2001, 87 minus 157 is 230. Then you just need to apply 230 into 14%. Right. Then here is the answer is 230 14, let's say. Yeah, I'm getting 6563. Yeah, correct. Right. Right. Two. Yeah. Yes. This is the tax. How you need to calculate remittent taxes. Then the important part is the total tax. The income tax is part. Sorry. No, Tirani, I can't hear you. Something wrong with the internet connection. Hello? Uh, Something wrong with the internet connection, I think. So I couldn't hear exactly what was the question. She left. Hello? This is the answer. Is it clear? They need to pay income tax this much, income tax, and then remittance tax they need to pay this much altogether, including this, not only 9 months and 3 months altogether. Right? Altogether, can we just see with the rate difference how they have benefited basically? How much they have get benefited with the rate changes. Yeah, income tax altogether they are paying 1788 plus 5111 to 2299. Then here they are paying remittance tax 918.82 plus 284.2. Let's say almost 122. Let's compare with the previous law and new law. Just see how much is the difference. Then they totally paid 2.3 million as income tax. 869 is remittance tax. Sorry, there is a one more thing we need to do the adjustment. I forgot that one. Sorry, before calculating the remittance tax, you need to deduct this income tax part. sorry, that part you need to deduct. Here, income tax paid. Income tax part, IT, income tax is one, you need to deduct income tax, because when I am comparing this one, I got error. That is also one learning point here also, you, because since we need to calculate the remittant tax after deducting income tax, right? 58811. So then just see, how to calculate this part, right? I'm just taking different color. Can anyone help on this? The figures. I will erase this. Here is, you know, 6,563. Here 230. Then you need to deduct income tax here. 6563 minus 1788. Then 4775 is 1. Am I correct?
Yes, sir.
Yes. 519. Right. Then only you can calculate the tax. 4775 into 14%. Sorry. 14%. Here 511 into 14%. Sorry. 1519. Then what are the answers? 1775 into 15 is 716, as a rounding now. 716. Let's say 716 million. Here,
So it's 668.5.
here 668.
No. For the first one, 668.5.
Yeah, sorry. 668, right?
Yeah.
668.5. Then the
The second one,
second one.
212.7.
Yeah, correct. Super. Then, in this case, then what you need to do is, uh, altogether this amount also you need to change it accordingly. Not this amount. Altogether, this amount maybe Then in that case, 668.5 plus 212.7 altogether 881.2. 1.2. Then there are some questions. See the now the with the different rate difference, if you can compare with the answer, if you can compare with the previous slide, keep in mind here, this one I will take this as a screenshot to the slide. Then it is easy for you to compare. Let me take this as a screenshot into the slide. I'm sharing the slide with you. Right here. Right here, if you can see, with changes, previously tax was 2.3 million, now 2.2 million with the changes. Then the previously it was 280, 869, now 888. Why they have, it is gone up? What is the reason? Because income tax become lower. Then we deducted income tax, then the remittant tax remain unchanged, no, 14%. That's why the remittant tax become higher. So that you can just analyze the part, how interesting. So there are some question also I couldn't look at. Let's look at that part as well. 2383869. Yeah. Yeah, why we didn't get fixed 67 for 9 months? We made, because the dividend, we explained the dividend is for only for 3 month period. The dividend is as per the circular. If you can check the circular, whatever the last 3 months received dividend, which is exempt, non-resident person, which is exempt from January onward. A question I will elaborate because I haven't mentioned in the question these dividend fall in under last 3 months. If you can if I can make it correct, this dividend is, let me mention that one, received received on 1st March 2020. Right? Then the last 3 months, let's say 31st, last 3 months hambala tiyenne. So if it is received on last 3 months, then we can consider when the dividend, when the distributing the company, resident company, when they are distributing, they will comply with the current law. Then the current law is, then it is exempt. Then the dividend received during this period, Jan to March period, then it is exempt for non-residents. Then is it clear? You not further elaboration? Do you want further elaboration? Okay. Then some, yeah, same question is asking. Yeah, right. Now all questions are clear. Now hope you all understood. Then the calculation part also clear. Then we will move to next section. Let's move to next section is the one, the I will go through quickly one by one these two questions also, because this is not a hard and fast rule. So withholding provision related to royalty. Explain the finance director withholding provision related to royalty. Explain the income tax rate on royalty income. Explain the applicable. So explain the applicable income tax rate on royalty income. So these two will explain quickly. First one is withholding tax provision related to royalty. Here, see withholding tax. In the case of withholding tax related to royalty, how you need to analyze. The section 84 provide that income tax on royalty will be payable. Normally, royalty says royalty in as per the Inland Revenue Act, section 84. If you can refer 84.1, is 14%. It is 14%, right? Then, therefore, company that they are required to deduct 14% when they are paying to Hera. Then the Sri Lankan company, then the company in Sri Lanka, they are required to deduct withholding tax 14%. 14%. It is clear. However, then first of all you need to highlight act provision. Act එකේ කොහොමද කියන්නේ? So then you just need to highlight, emphasize the act, what it is says. Then the however, DTA says, however, no need to write it down entire DTA article itself. You just mention 10%. As per the DTA, it is 10%. Accordingly, as per the article, withholding tax should be limited to 10% on the gross royalty when making the royalty payment to the company in India. Then interesting part. But they have but here, as per the section 4, non-resident, they are required to pay income tax whether income arising or derived from a source in Sri Lanka. Then as for the section 73, just you need to highlight section 73. Provide the list of payment source in Sri Lanka. And section 73 1C provide here royalty paid by resident person has a source. Royalty paid by resident person has a source. Accordingly, above definition, royalty payment made by a company in Sri Lanka which are resident person in Sri Lanka, these payments are considered having source in Sri Lanka, and Hera is required to pay income tax in the Sri Lanka because they are having PE. So then go back to then the source principle also emphasize. Then the first of all you just need to emphasize the section 84 royalty definition, and then you need to come back to the DTA provision, and you just emphasize the section 73 source principle. Then here source they conclude as accordingly the resident, these payments are considered having a source in Sri Lanka. Then they consider as a source. Then the interesting part, however, Article 12.2 is applicable in case of Hera, since in term of DTA, Article 12.4 of DTA. Here, if you can read the Article 12.4, this says what it is, basically. In India, paragraph 1 and 2, this beneficial owner of the royalty and technical service being a resident of the contracting carrying the business of other contracting estate in Sri Lanka, royalty and technical service fees. Then articles were 12 for just you no need to elaborate this entire article 12, right? However, Article 12.2 is not applicable in case of Hera in terms of Article 12.4, right? If you can refer the article DTA, I will share the DTA as well in India. Here is the article, royalty. Here royalty and technical service both. Here Article 12.4. If the beneficial owner of royalty fees and technical service being a resident of the contracting carrying a business of other contracting estate which royalty or technical fees for through a PE situated therein. Because they have a PE. They have a fixed base. They are non-resident company. They are coming to Sri Lanka Hera because agency PE. They have a agency PE. See this wording. Here anyway you know that 10% is as per the royalty. But Article 4 says, if there is a PE, Hera is having a agency PE. In that case, they have to compute the profit instead of taking 10%. If they have a profit, PE, then they have to compute the tax according to the Article 7, business profit. Since they have a PE. It's clear, I think now. It is clear. Then they have to compute. Then here, if you can read the same thing is there, right? Then they have a permanent establishment of fixed base because permanent establishment means agency PE. Hera is having agency PE. As explained above, Hera is deemed to have a PE through which business carried out in Sri Lanka. And Article 12.2 is not applicable. 12.2 is කියන්නේ මොකද්ද? 12.2 is basically rate taker. So 12.2 is here 12.2 this one is rate 10%. 12.2 is the rate 10%. 12.2 is not applicable. Then applicable is 12.4 because they have a PE. They have a PE. Right? Then 12.4 is applicable. In that case, 12.4 is applicable. In that case, therefore, applicable rate is for royalty income is 28. Then in your case, 28 and 20. Then other rate is what? 9 months and 3 months. Other rate is what? The recent rate 24. Then 2 rate you need to apply. 2 rate you need to apply. So 28 and 2 rate. You just if you are referring the recent changes, you just mention the royalty income. Then as a business income, then business rate need to apply because they have a fixed price. Permanent establishment. Hera is having. Then that part also clear. Then we are in the final 2 questions. We have only final 2 questions. We'll finish it up after this. Then the applicable income tax rate also we discuss. Applicable income tax rate is 28. With the recent changes, it is 24 for last 3 months. Then they explain if the Mahesh has to pay income tax in Sri Lanka on the following income. Employment income 3,000 and the 5,000 is sale of machine USD. Explain Mahesh has to pay income tax. Then we'll go through one by one is individual because I choose this question. A company also covering this one and individual also covering. Then in term of section 69 1B, section 69 1B says how to determine residency of a individual. We discussed that part in detail when we are doing the theory part. Section 69 1B and the section 71 of the IRA, individual who is resident in Sri Lanka during the year and that persons fall within the period or period amounting to aggregate of 180 days or 12-month period commencing on. This is, you know that exactly how to determine residency of a individual, right? 83 days or more in any 12-month period. Then just you need to elaborate the section 4 as well. I am just highlighting the section. You just need to elaborate the section 4. In the case of resident person, he is liable to pay. In the case of resident, he is liable to pay world income wherever arise. In the case of resident person income wherever paid, world income. As such, Mahesh will be considered as a resident person. Mahesh is resident person for this purpose. For the date he arrived has been in Sri Lanka and he has been in Sri Lanka more than 180 days. Because in the question we saw that he is 195. 195. He has stayed in Sri Lanka 195 days. 195 days. Then he is become a resident in Sri Lanka. He is liable world income. World income. Then, however, as per IRA, we need to justify. As per the IRA, we need to analyze this part. Right? This is IRA provision. How IRA says. Then, however, as per Article 15.2, Dependent Personal Service, if of the DTA is specified that even though resident of India exercise his business, his employment in Sri Lanka, his employment income will only be taxed in India if following conditions are satisfied. All conditions are satisfied, right? All, if all, here the important word is all of the following criteria are satisfied, right? All the following criteria are satisfied. Then what are the criteria? We discussed short while ago when we are starting the session. Then the physical person. Then the persons in Sri Lanka if it is more than 180 days, and the remuneration on behalf of the employer who is not resident, and the remuneration not borne by the PE or fixed base. If the all three conditions and is important are satisfied, then he is liable to tax in India. If not, he is liable to tax in Sri Lanka. Then you see the case, see how analyzed they are as per the DTA. Then as Mahesh is present in Sri Lanka for more than 180 days, because Mahesh is 195 he has stayed. So 180 days, then his remuneration is borne by a PE in Sri Lanka. Then his remuneration is borne by the PE. Hera is having an agency PE. His remuneration also borne by the PE. Then he will be liable to tax in Sri Lanka because these two conditions are not satisfied. Because these two conditions liable in Sri Lanka on his employment income for the purpose of foreign service. As such, he will be required to pay income tax in Sri Lanka on 3,000. Right? Then the last question is asking employment income, profit and sale of machine. Then the sale of machine, Mahesh being expert on technical aspect of the diamond cutting machine, he has used his knowledge to earn profit on a profit of USD 5,000 from his transaction. From this transaction, he has only made one purchase and one sale. entire period of 95 days. Accordingly, Section 3 and Section 4 of IRA, Mahesh is required to pay income tax on his income as a business, income from business. Previously, 3,000 is employment income. Now it is business income, right? Then, then the section 195 define the business is state business professional vocation isolated arrangement. Here even it is one transaction. 195 says business mean even isolated arrangement also included, right? Isolated arrangement in the business character. However, short duration of the agreement. Then as such, the Mahesh can be considered to be a business, and the profit of 5,000 of such business will be liable to tax in Sri Lanka. Then you just need to emphasize Mahesh part, and then 5,000 also liable, altogether 8,000 is liable here. Then the non-resident section part is also finished. Then we will have a separate next session regarding income tax administration. What is the preferable day? Even better if we can have it Saturday night, if you can confirm. Tell me, are there any suggestion? Because tomorrow I am having some other commitment. Whether you have any preferable day, you can suggest. Uh, then I can consider that one.
Present, sir. So
Yeah,
tomorrow
you just call me and confirm with once you confirm with others. Then I will.
we don't have any lectures.
Mhm. Tomorrow you don't have, no?
Yeah, tomorrow we don't have any lectures, sir.
Yeah, I am having tomorrow some other urgent work, office work. I will check whether we can have it tomorrow. If not, you just tell me any other day during the week, even weekend also fine at night. If you have any other lectures or classes, then even weekend night also that's fine. Uh, if you can just check without.
Lectures, sir. So, so we'll let you know.
Yeah, tomorrow I can't. Then any other day during the week or the end of the week, even weekends also fine. You just check with your team and the student, your colleagues, and let me know.
Okay, sir. Okay.
Okay, then. Okay, thank you. Then see you. I'll upload the recordings, two recordings as requested.